Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the 7 most ridiculously cheap stocks to buy right now for 2023 that will protect your portfolio, that give you at or around or even above a 5% dividend yield. So for more videos just like this one on the best stocks to buy, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. What I like about this video is we're going to focus on dividend yielding companies that are going to protect your portfolio and solidify it to protect it against any downside potential as we enter into 2023, because there could be a potential global recession. With these dividend yielding companies, even if their share price drops, you can reinvest these dividends to where next year you're going to get an even greater dividend, or it's going to help you dollar cost average your average cost basis for this particular company. This is going to add safety to your portfolio, and if you are already a dividend investor, then these are phenomenal picks. And we're going to start off this list with Bank of Nova Scotia, ticker symbol BNS. This company clearly is a banking and financial institution, and they regularly stress test their overall portfolio. This means that they are more than equipped and prepared to enter into a recession because they have already tested their overall portfolio for this circumstance. Investors should not expect that any of their loss estimates will increase during the near term, but instead they are set to be stable throughout the next year, on top of offering investors a very great dividend of 6.46% on top of just a $48 share price. The company is investing right now into technology and analytics to help increase their overall efficiency, and on top of that, particularly in regards to their mortgage sector, this bank has customers who have an above average FICO score, which is essentially how various consumers are rated on their ability to pay back debt. This means that their current customers who have loans and mortgages from them are not likely to default and not pay back their loan. This means that even during a recession, these people will most likely continuously make payments on any of the debt that they have accrued from this particular company, making this business very resilient and very safe, on top of offering a fantastic dividend. Lastly, I want to add for this company that its balance sheet is ideally structured to take advantage of asset repricing. So all in all, this company is a pretty safe bet as we enter into 2023. So of course, feel free to do your own research on this company, add it to a watch list, and even think about buying this company if it aligns with your personal investing strategy. The next company we have is British American Tobacco, ticker symbol BTI, which trades for $40 per share, and it offers a dividend yield of 6.82%. Absolutely phenomenal. Very strong dividend yield from this particular company. British American Tobacco, as you could have guessed, is a tobacco company, but they also offer a variety of other types of products. And on top of that, they recently announced that they had positive revenue growth throughout 2022. And by 2025, BTI will post revenues as high as $6.07 billion. Clearly, this company is continuously scaling while offering a very impressive dividend. It also enjoys very solid and stable demand globally, not just over in Britain or America, but they also have great exposure throughout the Middle East as well as Europe as a whole. It looks like BTI will continue to uptrend and increase their dividend payouts throughout the years to come, making this one of the cheapest yet the most effective and highest paying dividend company that you could find for this particular price point. So if you're comfortable with investing $40 to get a dividend yield of 6.82%, then this could be the company for you. Up next, we have a company called Ford Motor, and Ford right now is a gigantic legacy auto manufacturer, which currently trades for $11.32, one of the cheapest companies on this list, but they also offer a dividend yield of 4.4%, which is absolutely phenomenal. Right now, Ford is primed for growth, particularly in regards to their electric vehicles. They plan to invest over $20 billion into electric vehicles, and they already have their Ford F-150 Lightning, which is an electric vehicle truck. Recently, their Ford F-150 Lightning has got some backlash considering that they have increased the overall price by more than $15,000 above their original pricing. This is due to macroeconomic factors, various inflation-driven costs, and they need to put that forward to consumers, otherwise it's going to lower their overall margins. But in general, shareholders really like that they are going through the electric vehicle route. Now for me personally, I would skip this company and not add it to my portfolio, but I really don't know what the future holds, particularly in regards to their electric vehicle portfolio that they are building right now. The author of this article believes that the demand for Ford and their electric vehicles will increase over time and thus will help increase their overall share price targets and appease consumers as well as shareholders. But I do think there are other electric vehicle companies that are going to be a lot better to buy than Ford, but because this list is focused more on dividends rather than growth, that is why Ford Motor is on this list and their ticker symbol is F. Overall, Ford looks to be positioned in a very intricate way, considering that they definitely could increase their overall share price due to the widespread adoption of electric vehicles. And if they can find a way to produce cheap electric vehicles, this is going to put them in a very lucrative market. So over the long term, the profitability in terms of them returning shareholder value could be pretty impressive. The next company we're going to take a look at is Intel, ticker symbol INTC, which trades for $26 per share, and they also give you a dividend of 5.6%, again, pretty impressive. Similarly to Ford, I do like some other companies better than Intel, such as Nvidia or AMD, but nonetheless, this gives us a strong dividend. I am more of a growth investor, but during times of stock market and macroeconomic uncertainty, I really flock and run to value companies, blue chip companies, and dividend yielding companies, while also enabling drip investing so my dividends are reinvested into this company so my next dividend is even greater. Intel is mainly known for their semiconductors for PC processors, and they have a very attractive product lineup. As of late, investors have been dumping shares of Intel due to the very fierce competition amongst their overall market. However, this has caused some investors to believe that Intel is undervalued. Recently, Intel has actually updated their overall chip with Raptor Lake for even more performance gains, and this makes them extremely competitive in their overall market. The company also has two new major products on the way, which is going to add two major catalysts to their share price on top of giving you a very good stable dividend. Its network business will also gain market share as time goes on, but all in all, I really like this company because they are cutting operating expenses. If we end up going into a recession, we want to find value companies that have strong balance sheets that can tread water even while revenues are not growing and product demand falls. That's why I like Intel, because they have cut their overall operating expense. For instance, right now their operating expense is set to fall around $22 billion to around $20 billion in 2023. So they are saving $2 billion, and as their revenues stabilize and their costs and expenses fall, investors will find this stock as an attractive buying opportunity for not only their dividend, but their overall future growth prospects. Next, we have ticker symbol LYB, which trades for $83, one of our more expensive stocks on this list. But remember, if you can identify a brokerage or a company that offers you share slices or the ability to invest fractionally, you could invest into any of these companies for as little as $1. So please make sure and check if your brokerage and or financial institution offers fractional shares or share slices, so you don't have to dish out $83 for just one share. You can buy into these fractionally. This company trades for $83, like we said, and they offer a dividend of 5.65%, and their specialty and bread and butter are chemicals. This is a chemicals firm, which is very interesting. And they really operate synergistically with consumer energy, which has made this company fall to a pretty attractive price point. In addition, this company is rather green because it's finding more and more ways to use less CO2 for the overall environment. Now, for me, this is not one of my favorite companies, but all in all, this does give you a strong dividend that could maintain or keep your portfolio afloat throughout 2023 if we enter into a recession and the stock market completely crashes or totally falls out. Next, we have a company named Medifast, ticker symbol MED, ticker name MED. This is our most expensive stock on this list, and they trade for $111 per share with a dividend yield of 5.41%. Again, a very strong dividend. All these companies have at or around or potentially above a 5% dividend yield. Medifast is a nutrition and weight loss company, and they recently announced a quarterly dividend of $1.64. And that's very good for a quarterly dividend. Some companies do it quarterly, some do it monthly, some do it biannually, and others do it annually. It just depends on the company. So make sure to research the type of dividend that you will be receiving from these companies. Medifast does expect their overall revenues to increase to $1.59 billion for the year, which is very impressive. Now, one thing that I do want to highlight about this company is that their overall consumer base has dropped as of late. So they wondered why that was, so they ended up issuing out an overall survey to those customers who left. The good news is that none of these customers left because there was something inherently wrong with Medifast as a company, but rather because inflation and overall economic uncertainty scared them, so they wanted to stop spending money. So essentially, their main reason for leaving was due to high inflation and uncertainty on top of their ability to save money. So this is good news because it's nothing inherently wrong with the company about why a few customers have left, but rather due to the macroeconomic environment. And once the macroeconomic environment clears up, maybe potentially during 2023 or 2024, we could see this company have a fantastic rebound. But all in all, if you are a dividend investor, this could be a solid company. Now, I myself, like I said earlier, am not a dividend investor. I am an ETF and a large cap investor that focuses on mutual funds, index funds, and various other types of diversified investments. But that's not to say that I don't have a couple dividend companies that I really like to lean on, particularly during times of economic uncertainty. Lastly, we've covered this company before in a previous video, and that is Walgreens Boots Alliance, ticker symbol WBA, which trades for $38 per share, and it gives us a dividend of 4.96%. But what makes this company so special? Essentially, Walgreens Boots Alliance is the second largest pharmacy store chain with over 5,000 pharmacies. This is a drugstore that has around 200 collocated facilities, and they're also trying to break into the telehealth services market, and it really sets Walgreens apart from other drugstores in their same market. So if we can look at their overall price per share growth on top of their amazing dividend, we can see that this company is absolutely primed to give investors very good returns throughout 2023. And honestly, all of these companies, if you have drip investing enabled, will give you strong cash flow throughout a very volatile year, which economists say 2023 could be. So I would love to hear your thoughts down below. Go ahead and comment another dividend company that you really like and that you're buying right now. Subscribe if you are new or for more videos like this one, and I will see you in the next YT video.